Hello everyone, today we're going to take a look at Palantir, trading under the ticker symbol PLTR. After a week with plenty of volatilities around the corner, many investors felt the heat of overexposure. From a high of $20, it suddenly fell to around $15 last Friday, and has left many people wondering and hoping that it's going to be able to bounce back very soon. Before we start today's video, if you like my analysis, please remember to like, comment, and subscribe to my channel. Also, please check out the links down in the description and save them as bookmarks. Every purchase made on Amazon, not necessarily my products, but the links, will yield me a small commission at no extra cost for you. Thank you for all your continued support, and let's get started. Palantir has been able to rise around $15.75, marking a 2% increase compared to the previous trading sessions. In the morning, it initially dropped, forming a V-shaped pattern. Overall, the uptrend has been maintained, and currently it's considering whether the pullback should simply be a pause to better jump ahead. There are many voices in the market and also in the online forums that believe that Palantir will be worth considerably more, potentially up to $80 a share, in a future that is not too far from now. In order for this to be true, the artificial intelligence sector has to be the key momentum driver, and eventually to justify a significant portion of the additional value that the market would be able to attribute to Palantir. For the time being, it is sufficiently powerful at least to hold on Palantir's current valuation, which is already very significant compared to many other startup companies. Nevertheless, I think that it has a real possibility of bringing Palantir's value to a much higher place, since AI is still a relatively new field, and the sky is still the limit. So right now, the global markets are facing a complex interplay of factors that have the potential to significantly influence the equities worldwide. In this speculative analysis, I believe that the consequences of the global inflation, surging commodity prices, and declined quantitative easing, as well as the rise of inflation rates or interest rates, plus the geopolitical instabilities, are going to play a significant part. The increasing inflation rate has been putting pressures across the globe, threatening the purchasing power, raising the input costs, and impacting corporate profitability. Companies operating internationally may face challenges in managing rising production costs and also to sustain profit margins. Those dynamics could trigger market volatility as investors adjust their risk-return expectations. The upward trajectory of commodity prices, including energy, metals, agricultural products, have been having far-reaching implications for various sectors of the global equities market. The companies heavily dependent on these commodities may experience squeezed profit margins, potentially affecting stock valuations and investor sentiment. The reduction or the end of QE's quantitative easing measures by the central banks worldwide may have resulted in reduced market liquidity. So this in turn could lead to higher borrowing costs for companies seeking capital, which may also discourage investment activities or will. The elevated market volatility plus the reduced investors' appetite may also continue to occur. Now, the central banks around the world are tackling this delicate situation of balancing the inflation rates with the economic stability and, if possible, growth. Central banks opted for aggressive interest rate hikes to combat inflation. Borrowing costs for companies have been rising, which has also slowed down business activities and also fueling the market's volatility in terms of the equity prices. Now, ongoing geopolitical tensions, including trade disputes, political uncertainties, and social unrests, will inject an additional element of volatility into the global markets. Investors may adopt a cautious approach, shifting towards safer assets, impacting the equities. Additionally, the escalating conflicts may disrupt supply chains, negatively impacting the performance of international companies. Given the interconnectedness of global markets, the aforementioned factors have reverberating effects on the US equities market. Companies with significant exposure to international market may face a lot of headwinds resulting from the economic slowdowns, disrupting the supply chains and the currency fluctuations. But nevertheless, the US market is known for its resilience, and the diverse sectors may attract investors seeking safe havens. So, really, the current landscape is characterized by global inflation, surging commodity prices, reduced quantitative easing, rising central bank inflation rates, geopolitical instabilities, and also ongoing lack of certainty regarding growth. While the US market may exhibit relative strength due to the safe haven status, it's going to remain interconnected with the global economic landscape. For long-term investors, these conditions may offer opportunities to identify undervalued companies with strong fundamentals and international diversification. With that being said, short-term trades should be approached with caution because of the increased volatility and uncertainty. And also, we should be careful when assessing individual companies, sectors, or regions, instead of choosing ETFs. Going forward, I believe that Palantir has definitely shifted from an overall bearish trend to an overall bullish trend. We shall see what's going to happen in the upcoming few years when it's expected that the market will go through some kind of price corrections. Overall, I feel like Palantir will be able to hold on to its value and to generate a lot of profits to investors. For the time being, though, I do believe that holding on to the existing position and gradually adding in over the next 24 months would be the best way to go.